Welcome to the What to Watch video update. This is a video that I do once a week where I pull out the charts that seem to be saying something right now, and there's some things that we're looking for. And then I update these charts daily. I do a video each day, and there'll be a link below this video to take you to where those videos are at. I've gone through the process of discontinuing posting them on YouTube and Rumble. They're still free, but they're on a different website. I'm trying to avoid oversaturating my posts to see if that can get more folks who watch the videos and to hopefully get the insight that I'm trying to provide here within the videos that I do. Well, with the charts that we're looking at right now, I put them into three categories: positive, negative, and what we're watching. Now, you can go back and forth. There can be positive things on the negative side and negative things on the positive side. And some of the things that we're watching, we're just keeping an eye on. They could turn either positive or negative. So I'm kind of loose with the definition of what's positive and negative. When I did this video a week ago, right after Christmas, we were looking quite positive, and it was a little bit hard to find some negative things. Well, there's been some things building over a period of time that may get rectified, that may turn out to not be anything once we get back into the new year. This is coming up on the first real week when everybody will return after the holidays, and hopefully volume will pick up, conviction will pick up, and we'll see either things start to go to the upside, or if some of these negative things that have been building for a while start to develop and we go to the downside, or if we just see a continuation of what's been happening over the last number of months that might signal some kind of a character shift in the overall market. And this is being prepared for Monday, January 5th. Okay, first we look at the positive side of things here. Now, we did have a few down days. Like the week of Christmas was pretty positive. Santa Claus seemed to be on his way. Well, he kind of turned into the Grinch this past week, and we spent a lot of the week going down. Now, we bounced a little bit in Friday's session, but it's on well below average volume, not a lot of conviction, either to the upside or downside. Maybe that conviction is going to pick up in the upcoming week. The reason why we're still positive with this chart is we're hanging out above the 10, 20, and 30 week moving averages. And this is called the bow tie method, and this is short term. And we were coming down here. We held at the 30. That was pretty much the low that was set in Friday's session. And then we were able to get back above the 20 a little bit here. We're on other charts that I show, we're camped right at the 20 period moving averages. And the green here is short term, even shorter than the 20 period. This is a 10 period simple moving average. And we're still hanging out above that. So even in the short term, for right now, short-term support is holding. That's what we're going to be watching in the upcoming week. If this level and these other levels that I'll point out, if they continue to hold, if we break those, then we may go down to support that's still underneath where current price is at. And even though we pulled back a bit with the advanced decline line based on price and volume, we're still looking pretty good in the bigger picture. We're above advancing moving averages. We're just coming off of setting new all-time highs a week ago with the advanced decline line based on price as well as volume. So in the bigger picture, it's still taken as positive, even though it didn't have a really good week this past week. And after turning slightly negative, this is an advanced decline oscillator. It fluctuates when we get above 100 or down below 100. That's when we start to get extreme readings. But we still look at this every day. If it's above 50, it's more positive. If it drops, excuse me, below zero, it's positive. If it drops below zero, then it's treated as more negative. We were starting to turn negative, and after Wednesday, New Year's Eve, we were dropping down below it a little bit. And then in Friday's session with the bounce, slight bounce that we had, we were able to get back above zero here. That's why this is being treated as positive. But there has been some weakness. There's some negative divergences here. We were coming up and looking really good here earlier in December. We weren't really moving all that much as far as price, but this indicator was actually holding up quite well. And then we actually went up and made the all-time high here Well, we made a lower high with this particular indicator. So that's a little bit of a concern, a bit of a negative divergence that we're keeping an eye on here. And even though we're really dropping off with the new highs, new lows for the S&P, there's still a lot more green than red. Now, we did see a bit of a pickup here with the new lows as well as new highs in Friday's session. There was a little bit more conviction than what we've been seeing lately. This will pick up and start to either confirm more green if we start to go up or more red if we start to go down. And we're getting a mixed picture, but I'm still treating this as positive because it's been positive in the bigger picture. We're going up with the 5 period moving average of the new highs, new lows for the S&P, but we're declining with a 10 period moving average. So shorter term, we're holding up okay. A little bit longer term, we are seeing a little bit of weakness. And it's not that we're seeing an expansion of the new lows, it's more of a contraction of the new highs. And the VIX is behaving right now. Now, it ticked back up a little bit this past week because we were going down. It's still well below 20. Now, there's some things we're going to look at later on that are causing a bit of a concern as they apply to the VIX. But this is just a daily chart. We're below 20. We're getting quite low readings here, which shows there's not a lot of fear in the market. There's confidence. When we get to really low readings, that suggests complacency. And then we have a bar chart down at the bottom where the line chart is just the closing value. And this is still positive. We're below the moving averages. And even though it's gone up recently, it's still doing okay. And we're camped out right at the simple and exponential 20 period moving averages. We dropped a little bit below it earlier in the day on Friday after we started going down. We had a positive open, but then we gave that up and actually went negative. We were able to get back up to the 20 period moving averages by the time we closed. So this is short-term support that is continuing to hold for the time being. And here's all the different moving averages. We're still above the 20. If we drop down here, we'll be watching the 50 period moving averages. Then the next level down would be the 100s and then 200s down here. Are we going to be able to bounce up from this? Now, we came down to it on Wednesday, New Year's Eve, and then we closed right on it the day after New Year's here. And so for 2 days now, this support level is held. And that's pretty good. We'll see in the upcoming week. Are we going to be able to go up from this area? Have we tested this enough yet? Or is this just the beginning of more of a decline and we start going down to the 50 period moving averages? Now, from a longer term perspective of the short term time frame, I use a rainbow. It goes from 10 periods up to 50 periods. And even though we've been coming down here, we haven't been down here for very long. And so the lines are looking a little bit messy. They were getting a little bit messy back in November here. And then we come down, but then we quickly get right back above that. Is that going to be what happens now? Now we're a little bit into the rainbow here, but for the most part, the lines are still going up. And the reason I say long term, because this goes all the way back to 2021 here. I like to look at this chart to give me a bigger perspective of the short term time frame. And you can see we, for a lot of 2025, after we came up out of the lows last spring, these prices been above the lines and the lines are smooth and going up. We've kind of gotten into a little bit of turbulence here lately. We'll see if we get back above this moving average rainbow or if we stay in the middle of it or if we end up dropping down below it because we're seeing a little bit of vulnerability to the short-term time frame that I'll talk about later. This is an intermediate term rainbow going from 50 periods up to 100 periods with simple moving averages. We haven't even come down to this yet, so the lines are still going up. Now they're slowing down, they're getting a little closer to each other, but for the most part, the flow is up, and that still confirms that the intermediate term trend is positive. Long-term trend also positive. We're above all the moving averages here. It starts at 50 and goes up to 250 with moving averages, and we're still looking pretty solid from a longer term perspective. Parabolic SAR, when the dots are underneath like they are now, we're positive. If we continue to go down, eventually the dot will go over the top, and that would turn this chart negative. Now, this is a daily chart, and this is what I consider to be a primary indicator. And then here's a weekly chart of the parabolic SAR. And even though we've been chopping along sideways quite a bit with the weekly charts that we look at, we still see the dots underneath. And so on the daily side and here on the weekly side, we are still positive. And we're positive here with our trend, but we're not trending right now on the weekly side. Now, when we get over to the negative side, we're negative in the short and intermediate term based on daily charts because the red line has crossed above the green line down here. But in the bigger picture on a weekly chart, we still see the green line above the red line, even though there's some weakness with the green line coming down and the red line going up. We count this as positive because the green line is above the red line, but we're not trending right now. The ADX, that's the dark line. It continues to decline. It's below its moving average, and it's suggesting that we're not in a trend right now. If you just look at the chart, that kind of makes sense. We really haven't been moving all that much. After we were seeing more conviction going to the upside here, things have really slowed down. Is this going to pick up and we're going to continue to go up? Or are we going to continue to go sideways? Or is this going to lead to some weakness if the market decides it wants to pull back? And we're positive here longer term. This is a daily special K chart. And the special K oscillator is very long term. So I don't show it in the daily videos. I talk about it in this video and I show it in a couple of the weekly videos that I do here. But we're positive since we're above the red line. Very simple to read that. And we don't get very many signals. We didn't get any in 2024. We stayed above the red line the whole time. We had a couple in 2025 where we broke below as things were going down last spring. And then finally over the summer, it turned back to positive. So this is very long term. It's slow, but it gives us a bigger picture look at the overall trend. But this is a daily chart. The next chart is a weekly chart. This is even longer, and we still continue to be positive here. And the bullish percent index actually went up a little bit in Friday's session. And even when we were going down, the bullish percent index, which measures the point and figure charts of stocks in the S&P 500, it continued to hold up fairly well. And we're still just, it's hard to see it here, but we're just barely above the moving average. And when we're above the moving average, this is considered to be positive. Now, the next one, we declined a little bit, but I read this one a little bit different. This is the NYSE bullish percent index, a broader market measure. And we came down here, but I still treat this as positive since we're above 50. And then we look at the context. It's really hasn't been doing all that much lately. And we also use that same approach with the NASDAQ 100 bullish percent index. This has been declining. You could count this as negative, and we want this to be going up when the market's really strong. It's really been going sideways now to down, but I still treat it as positive since we're above 50. But the context to this chart is a little bit more negative since it's been declining. And then we turned negative after Wednesday with those stocks in the S&P above their 20-period moving averages. That's short term. Well, we had enough of a bounce in Friday's session to take us back above 50. So that's positive. And we're above 50 when we look at those stocks in the S&P above their 50-period moving average. After we had been declining, we bounced up a bit on Friday. Here's a 100-period moving average study, also still above 50, and a 200-period moving average study, also showing some recent declines because Monday and Tuesday and Wednesday were not very good this past week. And pretty much all the gains from the previous week, Christmas week, were given back in New Year's week. So, yeah. But we're still above 50 longer term. And so this is treated as positive. And even though we've been coming down here, this is an indicator that I developed decades ago. It's a 20-period simple moving average of the open, high, low, and close. We've been holding, and this is what I call a little mini rainbow because the other rainbows I show you have more lines. And we've been holding up inside of this rainbow. We're just about at the midpoint right now. And you look at a number of different charts, and we are at a midpoint where if we go up, that would lean things more positive. If we go down, that's going to turn things more negative. This is one of those charts since we're just about in the middle of the rainbow. And since we're holding at support right now, this is why I counted this as positive. And we're doing okay with the advanced decline line studies. We're coming back up above the moving average with the NYSE common stock. And that's been one of the stronger areas this past week. We're still above the moving average with the S&P. We're trying to get above the moving average again with the mid caps, and we're improving, but still below the moving average with the small caps. I focus mostly on the S&P here, and that's why this is treated as positive. And then the Dow was able to get, this is one of those tipping points right here. This is the pivot point for January for the Dow. And we had been coming down and we were able to get back above that. So right now we're leaning a little bit more positive with the Dow. It was up 2/3%, where we had the S&P was up marginally and the Nasdaq and Nasdaq 100 were actually down in Friday's session slightly. But I'm treating this more as positive. We're also above the 50-period moving average, and the longer term trend for the Dow continues to be positive. NASDAQ declined a little bit on Friday, but we're hanging out right about at this pivot point, another tipping point that seems to be coming into play. And what I've found over the years of using these, the pivot points seem to really matter when it comes to the NASDAQ and NASDAQ 100. They're also important for the S&P and to a degree for the Dow and the mid caps and small caps, but they seem to take on an extra level of importance. And the cool thing about the pivot points that are on this chart is they're on the chart before we even get there. These are going out into 2026. If you look at other charts, we already have February's pivot points on the chart. And so we know about them ahead of time. And we're just barely above the 50-period moving average here with the Nasdaq too. And we are also still in a longer term uptrend. So even though we were down a little bit on Friday, we've been holding up. And we're going to be watching this if we start to see some weakness, because this is growth. And if we start having a problem with the Nasdaq, that could feed over into the S&P 500. And then here's a longer term chart of the NASDAQ 100. That's the NDX. And we're still hanging out above this trend line going all the way back to 2009. So longer term, we're still looking pretty good here, even though we declined 1.71% for the week. Small caps, well, we came almost down to the 50-period moving average. We got back up. We're just about at this pivot point now. We didn't get to an all-time high again. Now this is the S&P 600, which is different than another small cap index that I'll show next, the Russell 2000. And so this chart hasn't been as strong, but we're looking okay here. We're above the 50-period moving average. We're back up to the pivot point here. We were up almost 1% in Friday's session, but we've been seeing a lot of this over the last few years where small caps have one or two really good days and then give those gains back. And this is supposed to be the time of year when the small caps perform really well. Well, they did the week of Christmas, but other than Friday's session, they didn't have a good week for the week of New Year's. And here's the Russell 2000 small caps. We're still holding above the 50-period moving average, even though we've been declining after it looked like things were starting to improve. Small caps like that interest rates are going down, and that's what's been feeding into them. Plus, this is a strong seasonal time for small caps, typically. Doesn't mean it always happens. It has happened over the last couple of years, only to see it fizzle out. And we're wondering, is that what's going to play out this time for 2026? But I'm treating this as positive because we're still in a longer term uptrend on this chart. And then the small cap growth to value ratio is actually holding up better than some other growth to value ratios that we have. And we were falling down below the 50-period moving average. We got that back in Friday's session. When this is really going up, now sometimes it doesn't really mean anything for the small caps because we've been seeing a pretty healthy ratio here, but the index really wasn't doing anything itself. But this is seen as positive when growth is outperforming value. Growth is more risk on. Growth is what you want to buy low and sell high, where value are stocks that folks get into when the market becomes more defensive. So this growth to value ratio is holding up better. Mid caps not doing very well over the last year or so. 2025 was not good for them. And consistently, week after week, I do another video where I rank all of the main indexes that we look at. And for a long time now, mid caps have been coming in last place. But we're still positive here. We're actually a little bit above the pivot point. We're above the 50-period moving average, and we are in an uptrend. But they just haven't seen it's been sideways for the most part as far as price action. But it's still positive for right now. Now, Friday was a good day for the semiconductor index. We were coming back down to the 50-period moving average, and then we were up 2.16% with the Dow Jones Semiconductor Index. Now, we did not get back to a previous high. We haven't even gotten back to this shorter term high that we had here, let alone the previous all-time high that was set right at the end of October. It would help if we were really going up with this. And because we like it when the semiconductors do well, that's huge. That's a major part of growth. We want tech to do well, but we want the semiconductors to do even better. And that's when the market is usually stronger. So for right now, this is holding up quite well. Now there's an SMH semiconductor ETF that did set a new all-time high on Friday. That was up 3.66%. So we're seeing it's not a real confirmation because the previous chart has us not at an all-time high, where this ETF does have us at a new all-time high, and this is quite positive here. And then we look at a ratio between the semiconductors and the tech sector. They can both be doing well, but we want the semis, as I said, to do even better. And so for the most part, this ratio continues to go up, and it had a really nice boost in Friday's session. Is this going to be able to continue? Now, in the bigger picture, this is still looking good and it's positive. And if it keeps going up, that will continue to be positive. If we start to see a real breakdown in this overall ratio, that's going to cause some concern, but not the end of the world necessarily. Because if you remember back to 2024, at the beginning of 2024, this ratio was just going to the moon. But then it started to break down. But the S&P was still setting new all-time highs. And this is when the Fed started to come in and cut rates. And even though this ratio was going down, the market was still holding up well. Well, when we had the problems last spring, that's when we were really going down with this ratio. It was tech and the semiconductors in particular that helped to bring us up out of those lows that were set. And so we want to see if that's going to continue or if there's going to be a breakdown here. We don't really go, oh my gosh, this is going down, start selling. No, we don't do that. We use this to say, okay, what's the context of the overall market? And for right now, it's still looking like the semis are doing quite well. In fact, this is a weekly chart that we're doing good, but we also want to be aware because this is a 200 period moving average of the Dow Jones Semiconductor Index. And so these are weekly chart or weekly bars here. And we're more than 100% above the 200 period simple moving average. Now, that's good, that's positive, but I have this dashed blue line here because sometimes when we get up to this level, that means on a longer term perspective, we're getting overextended and we typically will see more significant declines. We saw that right at the end of 2021, and then we went into the bear market of 2022. And we came up out of that, and it was the semiconductors that were really leading the way, and that really helped the market come up out of those lows. And then we come up here and then we spend some time above it, then we go down, then we go above it, then we come down. And but if you look at this and match up, see we hit a top here and then came down after that. We had a little bit of a pullback here in 2024, and then we saw a bit of a pullback. These are weekly bars again, but then we were able to come up from that. And then here's last spring when everything was falling apart. But we spent a lot of 2025 above this blue dashed line here, only to come down and go back up. Well, we're still above it right now. So we're positive because it just shows that the semiconductors are doing really well, but we're also cautious because this is up in this area where sometimes more significant declines can start. And then we look at the semiconductors, which is growth, to the Dow ratio. This is still doing well, not showing a lot of conviction lately because the Dows have been doing fairly well, chopping around a lot lately. But we look at this blue line. We use that as kind of a benchmark because we got up to a really high reading back during the dot-com boom and then ultimate bust. And then it looked like, okay, we're coming back up to this blue line again, only to break above it. So we're looking even more positive. And I still treat this as positive because we're above the blue line. A lot of people want to try to equate what's going on now with what happened during the dot-com boom and bust. And yeah, you could make some similar comparisons with all of that, but there's also a lot of differences that are going on. Companies during this time, they didn't have any earnings. They were just dreams. And then when the dream finally became a nightmare, that's when we saw everything going down. Where the companies that are really driving things now, they do have the earnings. They've stood the test of time. They battled through the whole COVID mess and the bear market of 2022, only to come up out of that and look pretty strong. So that's where I differentiate between what's happening now with what was happening back then. And I was involved heavily in the markets at this time as well. And then the Wilshire 5000, which is a broad market measure, we're still hanging out above the 50 period moving average. We were up 1/3% on Friday. We have been declining, but in the bigger picture, we are still in an uptrend. And then as a confirmation chart, this is the total US stock ETF, which the last time I checked had 2,651 stocks in it. And we're holding up here in another broad market measure. And so we're looking good from that perspective. And then we look at the NASDAQ 100 to Dow ratio. This is a growth to value. Even though there are growth stocks in the Dow, the NASDAQ 100 is pretty much all growth. This is also above this peak that was set during the dot-com boom and then ultimate bust. We've broken above the red line and we're still holding up quite well with this ratio. The QQQs, which is the ETF for the NASDAQ 100 and the small caps, again, we saw them top out here during the dot-com boom and then ultimate bust. And we're above the blue line and still looking good with this ratio. High beta to low beta, we're keeping an eye on some of our ratios now. This one is actually a little bit more positive. And in the bigger picture, it was really coming down as the market was coming down last spring, and then we finally bottomed, and it's really been pretty solid. There have been some significant bumps along the way, but we have been going up, and in the bigger picture context, this is still looking positive. If we do start to see things go down, we'll be keeping an eye on this chart to see if this ratio starts to go down. And then we look at a stock to bond ratio. And even though we've been coming down a little bit here, we're at the top end of the rainbow, stocks are still outperforming 3 to 7 year bonds. And the takeaway from this is when this is going up, and especially when we're above the rainbow, that means the market is not anticipating a recession. That's what we call a soft landing. If when we come down here and we start to drop below it, and last spring it's like, uh-oh, what's going on here? This is when the market thinks that we're going to go into a recession. And there was a lot of fear back then. And finally, we were able to get back up out of that. And then things started to look better from that point forward. And we've gone back more to the soft landing approach. This is that same ratio, but inverted, where we show how bonds continue to underperform stocks longer term. And this is encouraging. This is the SPY, which is the ETF for the S&P 500, and staples. Staples are things you have to have. Toilet paper, toothpaste. Even if the economy is in the toilet, you still have to have toilet paper and toothpaste. And so when the market gets more defensive, that's what the smart money gets into. We're looking good here. We're not seeing a breakdown at this point. It's not been showing a lot of positive conviction, but it's not really breaking down either. It was last spring as everybody was freaking out, pretty much convinced we were going to go into a recession. And then when that didn't happen and we started to recover up out of that, we recovered quickly. What I'm looking at is what happened at the end of 2021, because we started to roll over with this ratio and go down, but the S&P still set a new all-time high after that. It's like everybody was euphoric at that time, and then we started to go down. We're not really seeing that at this point. We'll be keeping an eye on this. I bring this up in pretty much every what to watch video that I do. I look at this chart every day, and on an as needed basis, I include this in the daily video update. So we'll be seeing if there is a breakdown here. But for right now, this is not happening. So I'm treating this as positive. And then from a seasonal perspective, the first part of January tends to be not the best performing part of the year, but it's one of the better performing parts of the year. And this splits it out each month out into two phases, the first half and second half. And this goes all the way back to 1950. Now, the second half of January, it does okay, but it tends to underperform the first half of January. Now the negative side here, and we had a down week. We were down over 1% with the S&P. So this is the intraday chart. And since we were down, I put this on the negative side. Each one of these bars is 10 minutes. I don't follow a 1 minute chart, 30 minute, 60 minute. I have those charts and I look at them occasionally. But what I found to be the most effective is a 10 minute chart that takes out a lot of the noise and you see more established trends. And that's just what I've concluded. And there are also pivot points that are on the chart even before the day starts that we can use as support or resistance levels. And we came down a little bit on Monday, and then we just kind of went sideways, really slow, holiday trading. Tuesday was pretty much comatose. Then we saw some weakness coming in Wednesday. This is when things started to drift over and look more negative overall. Then we had a gap higher in Friday's session, and but we weren't even able to get back up to the 6,900 level. We just kind of fizzled out here and then started to go down. And we actually went negative and chopped, but we held its support at this S1 level, which again was on the chart before Friday even happened. And then we did see a nice little bounce here, and we weren't able to get back above this solid blue line, which is the daily pivot. If we're above the pivot, that's treated as more positive. If we're below the pivot, that's treated as more negative. But that did act as overhead resistance here. And then we closed a little bit down below that, but still positive on the day. And since we had a down week, I had this on the negative side as well, even though it was up a little bit in Friday's session. But you remember that pivot point that I was talking about, where we're kind of at equilibrium right now? We're hanging out just about at that pivot point currently. So we're leaning a little bit more positive. We're just slightly above that. And if you look ahead over here, these are the pivot points for February that are already on the chart. So, and these are very useful tools. A lot of the algorithms that trade automatically, the computers, they have all this stuff programmed into them, and if we hit one of these levels, it says buy buy buy. If we've been coming down, if we hit a resistance level, then it says sell sell sell. Because a lot of trading that takes place on the exchanges are not even people doing it; it's computers that are doing it automatically. So we're still leaning a little bit more positive here, but because we've been coming down lately, that's why I have it on the negative side. And you can see we were way below average with volume. It's typical. This is, you can see back here in late 2024, volume really dropped off too. That's a very common thing when we have the holidays. And then we were improving as far as sentiment. And there's a lot of sentiment gauges. There's longer term ones that I do show in the daily videos. I like this one because it updates numerous times throughout the day so we can get a better handle on things. It's put out by CNN Money, and we were coming down, we were quite negative, but then we were improving. And when we get to a negative reading below 25, that's when we use it as a contrarian indicator. Well, when it finally starts to get moving, then we go with that whatever direction it's going. And if it's going up, we're positive. Unless we get all the way up to 75, then it's like, okay, now everybody's a little too happy. We're starting to look for using this as a contrarian indicator, and we were actually able to get back above 50. And this was Christmas week here, but then New Year's week, we started to come back down as far as sentiment since we were declining here. That's why I have this over on the negative side. And here's an intraday chart of growth to value. It's on the negative side here for a couple of reasons. One, we've been coming down lately. And number two, the red line is above the blue line. Where we want the blue line above the red line, that means that growth is outperforming value. Now, it doesn't, there are times when we do see the blue above the red line, and there's other times when we see the red line above the blue line and we still go up. So it's not a hard and fast rule, but we tend to be stronger when the blue line is above the red line. But with this past week, we've been under pressure more, and this chart has been showing more weakness. And then we have an intraday chart. This is shorter in the time frame, a 10-minute intraday chart of a growth to value ratio for the S&P. And going into Christmas, this was improving. We were getting back above the moving averages, but then we stalled out here and we've been dropping. We had a positive open in Friday's session, but that was quickly given back. And now we're back down below the moving averages here. So that's why I'm treating this as more negative. And then this is longer term. There's an equity put call ratio. Some people don't like this indicator. I think it's okay. It has its uses. And these are the number of calls that are being purchased versus the number of puts. And if there's a lot of puts, because they increase in value as prices go down, this ratio goes up. And this ratio goes down when the market's going up because there's more calls that go up in value if the market goes up that are being purchased than puts. Now, I really teach hedging in the program that I have here. So we pretty much use puts all the time, no matter what's going on. But for quite a while now, what we've been seeing on this chart, because there's a daily version of this chart, I have a 5-day chart, a 10-day chart. This is very long term. This is 253 periods. And I usually only show this in an informational video that I do once a week called the deep dive video update. But I want to bring this up because we're seeing a turn down here that's been developing for quite some time. And when this is going down, the market is going up longer term. And we've been coming down. And even last spring, this still continued to decline. That gave us a little bit more confidence that, okay, maybe things are, everybody's freaking out right now, but we're going to hit a bottom and then be able to come up out of that. We were still declining, not as fast, but then we resumed our decline as the S&P was going back up. Now we're seeing a shift, and we've been seeing this build for a while, where this is starting to turn back up. Now, we don't really see that. We're just coming off of all-time highs with the S&P, and this could still continue to go up more before either it will turn and start to go down and price will still go up, or until we finally see some kind of a pullback in the S&P. But this is a concern in the bigger picture. And if you see times when, okay, we were going up and then we started to go up here and then we had a downward move. And this is a longer term chart here. And then we were going down here and then we started to turn up here as well. And then this was 2013, 14, and 15 here. When doesn't look like it here, but those were some pretty crazy times in the market. We were going down and then we set a lower low here and there was some real concern there. And then for the most part, we've been coming down with this ratio, which is positive. And then we had the whole downward move after the COVID crash. And you can see it really wasn't impacted all that much because that crash happened so quickly. This is such a long-term moving average that we kind of got over it pretty fast. And then as we were just screaming up here, we were going up here in 2022 as I'm sorry, this was 2022, and that's the bear market where we saw this really screaming up. And then we finally bottomed and came up out of that. And with a few bumps along the way, this has been declining because you have to use counterintuitiveness here. When this is going down, that's positive. When it's going up, that's more negative. Well, we're starting to turn up longer term. So we just want to watch this, not predicting anything. There have been times when this started to go up and then turn and went back down. Okay, so we're not really, trying to say that declare any kind of a forecast. I don't do that. I just look at the current uh, evidence that we have right now and say, okay, this is what it's looking like. And we want to watch this day in and day out and see if it continues to go up or if it eventually rolls over and goes down. And we're seeing a little bit of vulnerability here. This is a double and triple exponential moving average of the 20 period moving average. Now, if you remember back on the positive side, we're still at the 20 period simple and exponential versions. These move even faster. And we're below both of these lines, and the lines are starting to roll over. And we're negative here because we're below both of the lines. If this continues to go down, that's going to be more negative in the short term. And we're seeing a little bit of vulnerability with the intermediate term based on 50 periods. Now we're still above the simple and exponential 50 period moving averages, but we've dropped below these two lines here and they're starting to flatten out a little bit. If we continue to stay below this, the lines will roll over and go down, and that will be more negative. And even when we're going up, the TTM squeeze is this indicator here. A lot of people, they love this indicator. I think it's okay. I look at it and I put it in the daily videos, but it's not one of my favorites because it gets things wrong a lot. But then sometimes it gets things right. Like we were going up here in December, especially Christmas week, TTM squeeze was still going down. So you would have missed out on that move if you were more of a shorter term position player here. But then as we've been coming down, the TTM squeeze is continuing to fall as well. Then here's the short term trend. And I use the ADX, the average directional movement, to determine that. And that's the black line that you see here. And we're declining and we're below the moving average. That means we're not trending. And if we get above the moving average, that means the trend is starting to get stronger. When we're below the moving average, that means the trend is weaker. And then we determine if it's positive or negative by where are the red line and green lines. The red line is above the green line. So in the short term, we have now switched to negative. We use that same approach with the intermediate term. And this is what I base everything around. We're still declining with the ADX below the moving average. The red line is above the green line. That's negative in the short term. Now, if you remember, we're not trending on the weekly chart, but we still see the green line above the red line. So we're still positive in the bigger picture. We're just turning more negative on the daily side, both in the short and intermediate term. And then I have three smart money indicators, which really, the smart money's been on vacation for the holidays. And so we'll see what happens with all of that in the upcoming week. The first one is accumulation distribution, and this is longer term. And even though we're coming down here, we're still above this red line, which is a moving average. So in the bigger picture, this indicator is positive. Then I have what's called a boom indicator, which is a short-term modified MACD, a momentum oscillator, and this has been coming down. This is why we're negative. Will be even more negative if we drop below the red line. Now, we turned up a little bit on Friday, but if we get back above the moving average, that will turn this indicator back to positive. But for right now, it continues to be negative. And this is smart money indicator number one. This is smart money indicator number two, the Chaikin money flow. And we're seeing this declining. The red line is going down. This is also negative. The third smart money indicator is the Chaikin oscillator, which still continues to decline. So all three are negative. And then we look at the McClellan oscillator, which measures the overall uh, uh, how are things inside of the S&P 500. And we're below zero. Even though we bounced up a bit on Friday, we're still negative overall. So that's why this is on the negative side. And then when the McClellan oscillator is negative, the summation index, which is a little bit longer term, we're declining here based on price and volume. That is negative and longer term. Then we look at the NYSE McClellan oscillator. Even though it bounced up on Friday, we're still below zero. So its summation index based on price and volume continued to decline. That's negative. And we saw a cross here. We were positive with the vortex where the green line was above the red line. Not now. The red line is above the green line here, so that has turned this indicator negative. And we're negative and below the midpoint here with the swirling trading oscillator based on price and volume. And momentum was actually switching over and looking positive the week of Christmas. Now it's switching over and looking more negative. I have a number of different oscillators here. The two top ones are short term, they're rolling over. Then I have three intermediate term oscillators, which are also starting to roll over. And then I have two long term oscillators, the Trix and KST. We're still pretty much flat with the KST. We were trying to get a little bit more positive here with the Trix, but you can see they're flatlining right now. And so any more weakness and these might start to go down as well. And this is another momentum oscillator that I didn't have room for on the other chart. This is called the Copic curve, which was just about ready to go positive. And now we're seeing some weakness. It's still below the red line. So that's treated as negative. And then this, the only reason it's on the negative side is we had a negative week. We were down 1.3%. This is a weekly chart of the S&P 500. When I did this a week ago, I thought, is the market going to try for 7,000? No, we didn't even get close to that. We do have overhead resistance above current price if we do try to make a run for 7,000 with the S&P, and we just didn't do all that much. We've been coming back down here, and we're seeing an awful lot of sideways action. Well, not really sideways, but we come down, we hit support. You can see this is a longer term pivot point. We bounced up off of that. We haven't gone up far enough to test this overhead pivot point yet to see if that's going to provide overhead resistance. And the NASDAQ 100, the reason why this is negative is we're just a little bit below the pivot point, where the NASDAQ itself is a little bit above. I wanted to put this on the negative side just because we're below the pivot point. We're a little bit below the 50-period moving average, even though the bigger picture is that the NASDAQ 100 is positive. The momentum for the NASDAQ 100, after trying to turn back positive, it's now turned back to negative. And here's the QQQs, the ETF for the NASDAQ 100. We lost the 20-period moving average. That's the blue line, and we're losing the 50. Sometimes this will precede the S&P 500 because this is growth, and we're seeing a little bit more weakness here and underperformance with growth than we are with growth and value, which is what makes up the S&P 500. So we're below both the 20 and the 50-period moving averages here. We're going to see if it continues to fall after this, or if we can get that back. That might be one thing that ends up happening, but this is more negative for the time being. And then mid cap growth to value. Now, you remember small cap growth to value is looking pretty positive since we're above the moving average and in an uptrend. Not here. Mid cap growth to value is not looking good at all. And then the FANG index. These are the big stocks, and I actually listed them here. These are all the stocks that make up the FANG index. They're underperforming right now. They're underneath their 50-period moving average. These are the stocks that really drive the market up or down. And these are the ones that everybody pretty much has heard of these names. And you might not understand a lot of the companies, but it becomes kind of cool to get into these companies. They're not doing really well right now, and they were down almost 1.5% in Friday's session. Home construction, and we look at a ratio between the home construction excuse me, ETF and 3 to 7 year bonds. They were improving here, but now they're not. They're down below the rainbow. And even though the Fed cut rates, 10-year Treasury yield has been fairly stable, we're still seeing weakness here and underperformance with this, and that's negative. And here's another growth to value ratio. Again, we're not falling apart here, but we set a high back in October when the S&P set an all-time high. We've been really underperforming, and you're going to see a lot of this. This is a negative divergence that I'm going to be pointing out here again in just a moment. Large cap growth, the reason why this is negative is we're dropping below the 50-period moving average. We're still above the 100. It's not like this is falling off a cliff, but it is showing some weakness. Now, we came down and we got to the 100-day moving average and bounced up. Then we came down again and bounced up from that. Are we going to come down and test this 100-period moving average again? If we hold and go up, that could be quite positive. If we break below this, that could signal that things are turning more negative. Then we look at some growth to value ratios. Not looking good. Qs to S&P below a declining moving average. Discretionary to S&P below the moving average. This had been doing better, but not so much lately. And then when we compare large cap growth to value, below a declining moving average. Then I break it out and look at the large caps below the moving average, mid caps and small caps improved, but they're just back up to their moving average. This is the one that's been causing a lot of problems for quite a while. We hit an all-time high last August with the S&P growth to value. This is an end of day chart, and it was doing really well, and it took us up out of the lows set last spring. Since that time, we have yet to make another high. In fact, we've been setting lower highs here and we've been drifting, and we came down under the 50-period moving average. That caused the 50-period to move down, and this ratio kept going down. Then we dropped below the 200-day moving average with this ratio, enough to then generate a death cross here. And we're just not doing all that good right now. Is this telling us something that there's some weakness coming into the market that so far has not really materialized? Are we changing the character of the market so that this could underperform and the S&P could hang on and still do quite well anyway? Or is this a longer term setup to give us some concern that may start to unwind itself as we get into 2026? Another ratio that is positive in the longer term, we're above the 50-period moving average, but we're underperforming here. When we look at discretionary to staples, this is one of the better looking growth to value ratios, and it's discretionary to staples. I treat it as growth to value, but it's not really showing any power right now, and we would like this to be doing better than it is. And now this is a different take on things here. This is very similar to what we just saw, discretionary to staples ratio with the S&P on top. And then we look at the correlation between the top part of the chart and the middle chart. And we spend a lot of time up here in this blue area. But you can see we came and we set a new high here when the S&P set the high back in late October. But that was strong. But then we started to underperform, and even though we're setting new highs here with the S&P, we're setting a lower high with this ratio. Okay, that's a negative divergence that we're seeing, and we're continuing to see this coming down because we see a lot of time we're up in this blue area, which means the top chart and the middle chart correlate with each other. And when it's in the blue area, that means they go in the same direction at the same time. They're both either going up or down together. we've seen that really dropping off now. Is that signaling some kind of a shift where, okay, where the S&P has been holding up okay? Because we were seeing this a week ago when the S&P was going up. This was still dropping down out of the blue area. And even though we came down this past week, we're still below that blue area. Okay, so is that telling us that there's going to be a disconnect and this negative divergence is going to get dealt with by price going down? Or is this just a holiday occurrence that's been happening lately and we're going to come back in 2026 here and we're going to get back up into this blue area and either go up or down and these are going to move more in tandem with each other. We're going to watch that unfold and I'm going to be updating these charts in every daily video. Then we watch another discretionary to staples ratio. Again, seeing this negative divergence here and a current decline. Then we switch over and we look at the Qs, which is the NASDAQ 100 to S&P ratio, and we compare that to the S&P itself. We also spend a lot of time up in this blue area. We're not there now. And we've been going down with this ratio as the S&P's been holding up. How's this going to play out? Now, I'm not a doom and gloomer. This could turn out to be quite negative, and we could see a pullback when we combine it with other things that we're looking at. But we could come back and the smart money could come in and do a lot of buying, send this ratio back up and send the S&P up as well and get the correlation stronger again and have this become a non-event. So I don't predict, I don't forecast. We just analyze and say, okay, this is what we're watching for. And then we watch it unfold day by day by day. And then this tells us, okay, now we kind of understand why things are happening the way they're happening. We look at another Q to S&P ratio, setting a high, lower high, now dropping as the S&P has been holding up better. And I use back here, this is the Qs to S&P. Here I use IWF to IWM. It's the same thing, but I'm using different instruments. But we're coming up with the same results here because I like looking at a lot of different charts. And if those charts are all saying the same thing, that's confirmation. It's not redundant duplication. It's just saying, okay, we're seeing the same thing across a variety of different areas where we're seeing this going down as the S&P has been going up. And here's another one using a couple of indexes where we've been going down as the S&P has been holding up with this growth to value ratio, another growth to value ratio that's even showing more weakness with some different indexes here. And then another growth to value ratio, which has been holding up a little bit better, but it's even it's underperforming right now. Now, I'm going to switch gears a little bit. If you remember back to the VIX, we're doing okay on the daily side. We're below 20. We've been coming up a little bit because this past week, the week was down. That's on the daily side. And I have a number of charts that I look at day by day by day. I do a lot of studies just around the VIX. This is a longer term chart, and I usually only go over this in what I call the deep dive video, and it's more for information. Well, I reworked this chart a little bit, and now we might be seeing something that we want to be aware of. This is the 3 month average of the VIX. And then we do a ratio with the daily version of the VIX. And when this gets up to a really high reading, notice a lot of times, not always, but a lot of times we spike and then we see a decline. We spike and then we saw a really short-term decline before we went up. Now this one here, we saw a spike and a decline and we still kept going up. So you don't want to base everything right around this chart. Here, this led to a more significant decline. This was going into 2022, the bear market. We saw a real high reading here and then we went down after that. And then we had another one. This kind of was near a bottom here in the short term. This one led to it took a little while, but then it led to a little bit of a pullback here. Then we saw another spike, and then we ran into some trouble. This was in 2024. And then we saw another one back here in 2025. That led to a little bit of a decline. So it's not telling us the magnitude of a decline. It's just saying be aware because we're just coming off of getting a very high reading with this chart. And now we're seeing a little bit of a downward move here. Is that going to continue? It's not automatic, but we want to be aware of this so that we're not caught off guard. And then this is a weekly chart of that same thing. So we get a little bigger picture perspective here where we spiked up and then we saw a decline, spiked up and then a decline, spiked up and then a decline. All right. And then we're spiking up. Is that going to lead to more of a decline than what we've seen already? Just something to be aware of. And these are new. I haven't showed these in the daily videos yet. I was just playing around over the weekend and was reworking this chart and changed a couple of things around and went, oh, this is kind of useful after all. All right, then those things that we're just keeping an eye on. We want to keep an eye on jobless claims. They really dropped in the latest reading. Continuing claims are coming down. I thought they went up. It's still hard the data with the government shutdown has been really hard to depend on here, but we want to keep an eye on continuing claims. We will be getting the employment report this upcoming Friday, and this puts it all together. We'll get an unemployment rate update when the jobs report comes out. Want to keep an eye on volume here. It's been way below average. It should pick up in the upcoming week. And we were more than 10% above the 200-day moving average with the S&P. Now we're dropping down. And just like I was pointing out with the semiconductors, when we get above this blue dash line, and there's no magic level as to where that is, but then we start coming down and dropping below the blue dash line, that often leads to more significant declines. We've seen that happen a lot in 2025, and it really didn't lead to much. It would have helped us out with the downward move last spring, but we've seen this hanging out around this level and then dropping only to come back up. So we just want to be aware of this, and that's why it's on the watch side. And then these are some ratios that we're looking at, the risk on to risk off ratio, just chopping a lot lately. And this is a staples to tech ratio, chopping a lot lately. When this is going down, that is more positive. When it's going up, that's more negative. Also, when the staples to the S&P ratio, when that's going down, that's more positive, but it's been real choppy lately. We want to watch the ratio between the S&P and utilities. Not really showing a lot of conviction lately. We'll see if that ends up changing. And we want to keep an eye on the dollar. It's in a downtrend on the daily chart here. We were trying to generate a golden cross and then we dropped down below the moving averages. Now that's been helping. And the dollar going down really helped us come up out of those lows in last April. And because the dollar was weaker, the stock market likes a weaker dollar. And that's also been helping gold to go up when the dollar is weaker. If we will be keeping an eye on gold, we'll be keeping an eye on the dollar. And if we start to go up, that could put some pressure on stocks. And then here is a weekly chart of the dollar. It's in an uptrend. But like we see quite often here, the minute we see a crossover, we drop down and we go below both of the moving averages. That's one of the drawbacks to using moving averages is that they lag. And we want to keep an eye on the 10-year yield. We're kind of at the higher end of the recent range that we've been in now for quite some time, but not really causing an issue with the market. This is the spread between risky and not as risky bonds. This going up means fear is coming out of the market. So for right now, this is looking okay. If this really starts to drop, that's going to cause us some concern. And then we look at different ratios. This is the weighted version of discretionary to staples, which has been under pressure. And even the equal weighted version has been under pressure. Then tech, which is growth to utilities, that's been going down. Biotech, which is growth to healthcare, that's stabilizing a little bit, but it's been declining. And then we look at hotels, which is discretionary. You could sleep in your car, versus utilities. You have to have that. This has been coming down too. We're seeing some weakness here. So we would like all these charts to go up if we're more positive. We're a little bit concerned here that these ratios are going down. And also keeping an eye on the semiconductors, which are doing quite well, but not back to all-time highs yet. Home builders, that's a chart I pointed out earlier, not really strong right now. Transports, which were drifting off after really going up nicely, they're holding up for the most part right now. Retail, that's been drifting off after it's been going up. And then the regional banks have been drifting down as well. We need to see some strength. We've been seeing it in the semiconductors, but we need to see it in these other areas for the market to get more on offense and be more positive. And then we look at ratios between US and international stocks. We've been drifting here. We're kind of coming into the lower end of this recent range that we've been in. Momentum stocks, which if we go down and this goes up, that's what happened last spring. And that gave us confidence that, okay, we're going to find a bottom here at some point and then bounce up out of that. Well, we haven't really been moving all that much here. We were declining back in October, but if we do go down and this goes up, I'll be watching that and I'll be bringing it out in the daily video. And then emerging markets, which they're setting all-time highs right now when compared to developed markets, which includes the US and Europe. But this ratio had been coming down. Emerging markets were underperforming. And right around this time of year, it's common for emerging markets to see some favor and actually show a little bit of outperformance. We'll just be watching to see if that continues. We want to keep an eye on oil, which is in a downtrend, getting into the 57 range. That's more for geopolitical reasons. And then here are the daily pivots that they're on the website, and I post them on the YouTube community tab as well. So thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.